Today's market update is going to be for January 25th. It's the end of the day, and of course, I provide end of day coverage for global currencies as per my option sentiment indicator. This is just going to go over kind of like some gaps that we've been just kind of missing, you and me, as far as the Twitter sphere is concerned, as well as the internet. I've been on hiatus, just kind of waiting, and going into this quick presentation here, shouldn't be longer than 10 minutes. We're going to cover the global financial markets just very easily and swiftly, and as well as talk about some of the end of day sentiment indicator on what I primarily focus on, which is the Euro ETF. Let's kick off with global currencies. We have a waiting game for the euro, and this is something of a cat's game that I see in just the overall currency markets, is that there really is no true direction. And so I think I had pretended before in the video that to say that the euro at about $1.04 against the US dollar would have a tendency to go up, and so this was a beautifully easy trade to make. Post election Trump rally, I think it just made sense based on the premise that there was only so much further that the euro would go down until it was going to reach this parity movement, which is a very scary scenario for the EU bloc being torn apart. So the premise for the euro to go up was simply risk reflation. So a reflationary trend, which would say that it should no longer be suppressed by market forces, but just kind of continue and trend along with prevailing markets, that the euro was due for some kind of a relief rally, which is, I think, what we have seen. And the next point to make here in the foreign exchange is that the Brexit invocation of Article 50 should be coming up. I don't know the exact date, but you may reach out to me, and I will find it, the exact date. I think it was in March, or it was early March, I believe, that Prime Minister May would invoke Article 50 by any means necessary in order to sustain England's United Kingdom's trade partnership with Europe, while still seceding or withdrawing from the EU altogether as a currency partner. So that's a very legislature just kind of segment, I guess you could say. It's interesting just because it is creating a lot of social upheaval amongst the UK. Including Scotland, which has now found its wings in being able to sustain itself as a EU partner and be part of the euro currency bloc, but while also being free of well, still being part of the EU, but still being free of the UK. I believe I have that right. Could be mistaken there, but in anyways, Scotland has found some wings against that prevailing kind of trend to say that all of UK would be separate from the EU or from the euro. Now, the French election in 2017 is going to be later this year, and so I think that will create dramatic improvements in, I guess, or I should say, dramatic significance within that whole atmosphere of what is essentially a right-wing trend, and I think is a prevailing trend that is going to be profound for 2017, that continues, and I think we should see surprises, and these are going to be the most significant factors within the European trade partnerships and within the overall sentiment of their economies, with France taking center stage later in the year. Next slide, we're going to be looking at commodities. I don't really follow this very much. However, we are overdue because after the I guess the dragonesque, I guess you could say, bull run of the gold and overall commodities had just sort of hadn't sustained itself and just sort of willowed out. There hasn't been much interest in commodities, especially with oil, sort of tanking as well. But however, we are kind of overdue, I think, with this directionless market. We are overdue for a run up in a single commodities future. Am I saying that right? A single commodities futures product, whatever you want to call it. So, for instance, possibly, I would say that in the energy futures sector, there could be a huge run up in Grand Slam home run for 2017 for perhaps, natural gas had shown some kind of coloration with it going up to, doubling in about a year in its futures. So I think the energy futures, I think, have a possible leg up or any commodities. I mean, it's simply just to say that in a directionless, interestless financial market landscape, that the commodities futures may be overlooked. Next slide is the economy, the U.S. economy. Interesting. I think we've reached a peak. I think this is an interesting time. I think we're in some type of bubble of some sort, a recurring theme, which is fine. The thing I think that is necessary to say is that we do have a weak trade outlook with post-election results, with Donald Trump swiftly withdrawing from the Trans-Pacific Trade Agreement. I think does just sort of give a signal of saying that instead of bolstering our trade, I think at this point we're just going to be seceding ourselves and kind of going towards isolationism, not for the sake of obviously being isolationist or to say that we don't have trade agreements in the works, but at this rate, I think it's safe to say that we don't have the same kind of trade surplus or expectations as we did as perhaps in 2009 or 2010 when hammering out agreements to save the U.S. economy was actually spurring incredible numbers within the trade and net exports growth, which was a huge support for a bull market. With that said, there could be possible tensions that rise with the trade partners that we have, and there obviously needs to be some kind of resolution to say, look, I mean, we were willing to dance and we're willing to work with you. However, you're offering us some kind of North American thorny issue, and we need to make some kind of resolution to at least show, like for instance, that you're willing and able to work with us to be a fair and reasonable trade partner. So it's a difficult situation, and so we're just going to not cover that right now. But that begs the question, what is the resolution for the U.S. trade outlook? Next slide is equity markets, and like I said, we have this recurring theme that is kind of a bubble, and it's kind of glorious that we've reached this. Silly, but it's glorious nonetheless that Dow Jones reaches the 20,000 price level, and I think this is really just a pinnacle from a positive January effect, which says that people would buy on the dip after selling their losses and from the end of year losses, and also reinvesting some of their tax withholdings. However, even though we might just be at a peak, a pinnacle, it's not really time to worry. I think in fact it's the opposite. This is the beginning of madness and the beginning of hyper speculation and price bubbles. But I will say this is that the most current price action really is going to, I haven't been following equity markets through and through, but however, I mean, it's going to really portend to something sentimental. So I think if you are a sentiment trader, if you engage in sentiment analysis, I'd be interested in your weighing in on, how much of a factor sentiment is in this very day and age of markets. So, the end of January, I think it's fair to say that sentiment is playing a substantial role in the price action. So that leads to the obvious cautionary note, which is to be wary, when fundamentals weaken, which is going to be very soon, I think. Not to say that it's going to totally fall apart. It's just that there's definite soft patches that are going to arise, and it's going to be kind of a bumpy road for the U.S. economy, during certain quarters of this year. I don't know. I mean, it just could be a fallout at the end of the year, but at this rate, I think it's not time to worry. However, if you haven't really taken a look at the financial sector, and if you haven't got into sector rotation, I think you're not so much too late, but that you're not aware of that there has been a sector rotation. But however, this has been actually bad. I think it's been a bad sector rotation, because it's just leading to really, I think, very unsustainable risk factors, which include possible liquidity fallouts, such as those flash crashes and hiccups from high frequency trading. And there is credit risk. There is a great deal of credit risk that is always going to be underestimated in times like these. And then there is a huge weakness, I guess you could say, and a threat, which is the over trading. So there's just going to be over churning of accounts institutionally, and over leverage. So when the financial sector rears its head, which it has, and it's roaring, and it which is to say that it's pretty much the king of the jungle or whatever. Well, I mean, if you look at the fundamentals of financials, typically they're going to be over leveraged, and they're going to over lever themselves in order to sustain what is essentially investment banking activity, such as mergers and acquisitions and IPO issues. So this poses actually a great deal of risk for the overall economy and global markets. Now, just to kind of cover all the bases, I think it's obvious at this point what are some good stock picks in the real estate investment trusts, as well as the hospitality and service sector, industry, I should say. And so it's something that you might want to just study and research, and if you play your cards right, I think you'll do well. But I don't think it's something to look at with a other than a grain of salt on a daily basis to say that every day is going to be a winning day, because I think at this rate the expectations are that we've reached some sort of a perceived top. So that's just, there's nothing to take away from that other than to be cautious. And this obvious strength or expectations, I don't know if it's really the performance hasn't been showing stellar performance. However, this strength and expectations is also underlying a prime weakness in the consumer discretionary sector, which has been the major driving force for stock prices for the last 5 years. It's been like an ATM machine. So that's something to be aware of. And so I think this is a market for a long short global macros perspective. So if you have that perspective, I think you'll do well. And that leads us to bonds. So the bonds they're in a world of trouble right now with just a lot of recessionary factors the prices have just gone wildly against them, and so I think it's a testing time just to really test one's ability and their tactical awareness in the markets, because it really is going to be critical. And my suspicion is that the over trading and need for constancy, and the need to stay even in the trade, is going to create a lot of whipsaws in the financial markets and create a lot of volatility. But I don't think it should overthrow any of the price action in stocks and equities. So just with that said, we'll take a look at the sector overview. Just if you notice the huge green bar, which is the financial sector. These are all the sectors of the S&P 500, by the way. Each of these are the components of the S&P 500, which with each major sector. And the financials, I mean, for the last 6 months, I mean, is ridiculous. It's just been destroying the entire markets. And, you know, I don't see this as being a strength. I see this as being actually a, I actually see this as being a threat. So not so much in the threatening sense, but in the risk sense. So in other words, I think you should be discounting this factor as opposed to seeing the pinnacle at 20,000 for the Dow Jones, in other words. Anyway, so going to the end of day today, January 25th, and so, you know, it's just taking a look at some of the sentimental factors. I take a look at the sentiment trading factor of the Euro ETF. In this case, it's kind of it's a contrarian indicator that I've just back tested. And so in this case, these results that you see here in the table are from the 2-year results, not necessarily the last 2 years, but from May 2016. From May 2014 to May 2016, I believe. So it's 2 years of data. And the OSI plus NAV, that means that those are the, that's a confluence, that's a combination of my proprietary option sentiment indicator with the closed-end fund discount, which is a contrarian indicator. So interesting factor here. To go along the lines of the long-short theme, I think having a long-short perspective is huge, and I think having a tactical awareness is huge in today's market. And so this offers that. If you can understand what I'm saying here, it's kind of jumbled up a little bit. However, the OSI, the option sentiment indicator, is a coinciding indicator. And the NAV represents the closed-end fund discount, which we're using as a proxy for a contrarian indicator. So if you can understand what I'm saying, you're combining what is a coinciding indicator for sentiment and a contrarian indicator for sentiment. And so that this way, you know, you're able to sort of check your risk factors in a sense, and you know, the results have been good. I mean, they've proven to be good. So I mean, with a hit rate of above 55%, I think that's pretty good for 2 years. And the Sharpe ratio, non-existent. You know, not the greatest Sharpe ratio. However, you know, the hit rate is good, and so just combining those two factors, I think, is a good way to hedge your bets, I guess you could say. So that's all I'm going to say for now. Please do weigh in if you have anything for sentiment analysis, sentiment trading, and also reach out to me with any questions, comments, or feedback. I look forward to speaking with you later. Take care.